everyone, and happy Saturday. Thanks so much for tuning in to another one of our self-directed IRA classes. Today we have Adam Barr, CPA, here to talk with you about some tax saving strategies. Prior to us going into that, I will briefly run through a few announcements and then I'll pass the mic to him. But first and foremost, if you're familiar with this class, you're familiar with these disclaimers. Quest Trust Company is a self-directed IRA custodian. We do not offer any form of tax, legal, investment, or structuring advice. And of course, if this type of information is sought, it is important that you reach out to the proper financial professional to receive it. So we're going to go through that first. Next, I'm going to go ahead and move on to the second slide. This is going to be our November promotion. This is $125 that will cover your first investment with Quest. So if you're eyeing a property or there's a multifamily syndication that you're wanting to get in on here within the next month or so, go ahead and reach out to us. We can go ahead and apply this promotion and essentially pay for that first investment on your behalf. So certainly something to take advantage of here in the next few weeks. And with that said, we'll move on to the next one. This is the QR code that you can use to schedule a consultation. Our IRA specialist will walk you through the logistics of opening the account as well as the cost. So if you'd like to schedule that consultation for yourself, a friend, another member of your network who has the need for something like a self-directed IRA or even self-directed IRA investors, feel free to scan this code here, shoot us an email, or give us a call during business hours. We'd be happy to take that consultation for you and talk through what a self-directed IRA could mean for you. We do also have an event. Now, these two of these have passed. So that would be our November 7th and November 9th in the Houston and Austin, Dallas office, respectively. We did have a rental continuum forum where we have individuals coming up to speak on a panel to talk about short, midterm, and long-term rentals. And then we're going to have a panel of all three. Our Dallas one is still upcoming. It's on November 14th. We will also be hosting that panel online as well. So if you have any questions in the rental space, I highly encourage you to register and attend this event. This will allow you to ask those questions directly to the speakers live, and it gives you great access to some of the experts in these respective industries. So certainly recommend checking it out. You can find it on our website, or you can scan this QR code here to attend. And I do also want to mention our QuestCon live event. So this is a virtual event that's coming up for us on November 17th. That is next Friday. It is completely free to attend, and this is education in the entire alternative investing industry. So we're talking real estate, private lending, cryptocurrency, really all over the board of where private investments can go. And so we want to talk to you a little bit about what that's looked like in 2023 and where it may be going here in 2024. So we've got a lot of really great panels lined up for you. It will be an all-day event, so 9 to 4 Central Time on November 17th. Highly encourage you to register for that. Like I said, it is free, so it's easy to register. We'll send you a link and you can join in. Some of these panels as well will also have live Q&As. So again, any questions you may have, you can have them answered at this event. And we're really, really looking forward to it. So feel free to scan that QR code and register today. And for those of you who have been with Quest for a while, whether it's just on the event side, you go to our online events or in-person events, or maybe you're a new client coming in as well. This is an event that we host, a large trade style like event. This next year in June, we are actually going to have it in Irving, Texas. So we had ours last year in Houston. This one's going to be more close to the Dallas audiences. However, we have people coming from all over the country to attend. We're projecting about 800 attendees at this event. Very much looking forward to it. Again, not focused specifically on IRAs, but more so alternative investing as a whole. So this is something I would encourage you to look into. We do have some early bird discount prices on the tickets if you're looking to register here soon. So feel free to scan this QR code, go to our website under special events, and you will find all of the information you would need to make your decision on that. And that is all that I have for you guys. I am going to go ahead and pass the mic over to Mr. Adam Barr and let him finish out this webinar here within the next 45 minutes to an hour. I encourage anyone with questions to use the chat box. We'll absolutely have some time at the end to take advantage of that. So Adam, it is all yours.
Thank you very much. Welcome, everyone. I'm so excited to have you here to discuss unlocking tax savings, which is a presentation I recently developed for small and medium-sized businesses. So before we jump into it, I'll give you a little background about who I am and where I'm from, I suppose. So I work with MGA LLP, Miller Gross Bard Advisors for Loan. We're a full-service CPA firm here in Houston, Texas. I am one of the tax partners at the firm. So I'm a tax professional with about 11 years of experience in all things business tax. We primarily serve business clients, operating businesses, usually revenue in the range of maybe a few million, maybe 5 million to about 100 million in revenue. We do have a few that are larger than that and a few that are smaller than that, but that's our general range. And that's in a wide variety of different industries and professional service firms, a lot of real estate, manufacturers, wholesalers, restaurants, hospitality, you name it, we pretty much do it. So we're here for the business tax person. We do the tax work, compliance and planning for the business owners and the owner's family and the owner's trusts and all that as well. We do very little personal income tax work that is not associated with the business, so that's not really our area that we focus on. Our business model is how do we add value to operating businesses, both in the Texas market and around the country and even outside of the U.S. I also, as many of you know, often give presentations with Quest on unrelated business taxable income, UBTI, or the unrelated business income tax, UBIT. So sort of a side area of my business is I help Quest clients and others who have self-directed retirement accounts that invest in businesses and other types of assets that have a tax reporting requirement. So if either of those things I just described applies to you, I'd encourage you to consider reaching out if you need some assistance after we go through this presentation today. So I appreciate you guys taking the time and letting me talk at you for a little bit here. We're going to get into a lot of fun and exciting topics, but first we got to do everybody's favorite thing, which is the disclaimer. So I know that Quest gave you guys a disclaimer, but this is my disclaimer, which is this presentation is just for your information and your education. It's not tax or legal advice. It's not financial advice. And the reason it's not is that everybody's situation is different. And so a lot of what I'm going to be saying today is very general in nature and is accurate and useful at a general level, but your specific circumstances may dictate different conclusions and different things that would be, advised on basically. So I would recommend that you consult with a qualified tax advisor or legal professional if you have any additional specific to your situation questions about this after the presentation. So with that out of the way, let's take a quick rundown of today's topics. These are going to be the main things that we're going to talk about, but I've inserted some maybe 2 or 3 bonus topics throughout the presentation that we can cover if time allows. I'll try to stay timely so that we can get to all of it, but these are the main topics here. We're going to be talking about what federal tax classification should your business choose to optimize both the tax result and also to optimize the elements that you need to have in your structure from a legal perspective or from other perspectives. We're going to talk about why we don't recommend using an S-corporation to hold real estate, especially rental real estate. We'll get to that. We're going to be talking about the difference between being a cash basis versus an accrual basis taxpayer. So if you haven't heard those terms before, buckle up because we're going to have a good time with it. We're going to talk about the question I get the most often in my practice, which it always kind of baffles me that everybody asks this, but should I lease or should I buy my vehicle? And there are some important tax considerations there that we'll address. And then we'll talk about a topic that's very near and dear to Quest and myself, and that's tax deferral with retirement plans. All right, so we'll roll right on in with choice of federal tax classification, or how do I choose the right tax structure for my business? And again, as we jump into this, the person that I'm thinking of in my mind when I'm having this conversation with you all is someone who has an operating business. Maybe they have revenue of at least several $100,000 to a few $1,000,000 a year. That's probably the kind of person that is going to benefit from this type of discussion the most. But anybody who's in business for themselves, including, if you're a freelance contractor in your industry, this is something that you need to think about. So it's pretty broadly applicable. The first potential way of structuring your business is as a single member LLC or as a sole proprietorship. So a sole proprietorship is a big fancy word that just basically means you're the only owner of the business and you operate it as just you, right? And so that can either be with or without an entity. So if you are in the business of providing consulting to the oil and gas industry, just as an example, and they pay you as a contractor, then you can think of yourself as being a sole proprietorship. You're in the business of selling your knowledge and expertise. Whether you choose to use an LLC or not as part of that sole proprietorship structure is really more of a legal liability question. So you probably want to have a discussion with an attorney on that. But a lot of folks choose to use an LLC for this type of business to give them some legal protection in case something goes south. And so basically, anytime you have a single member LLC that is an LLC that has only one owner, it's treated as a disregarded entity. That's the term that we use. And what that essentially means that in the eyes of the IRS, for federal tax purposes, that entity is not considered to be separate from its owner. Or to say it in a simpler way, if you have a disregarded entity, the activity of that entity is just reported on your personal tax return or on the owner's personal tax return if it's owned by another entity. But this is the simplest structure you can have because essentially you're just reporting all the income and expenses directly on your tax return. The entity doesn't pay any federal income tax, it's paid by the owner. And generally speaking, in most situations, all of the business income is going to be subject to self-employment tax. Self-employment tax is going to be coming up multiple times in today's discussion, but essentially it's a replacement for Social Security and Medicare tax for people who are not employees. So that's an important point, is that generally speaking, in most cases, all of the income from operating a business in this type of structure is going to be subject to both regular income tax and the self-employment tax. We're going to get into some planning points later about how to reduce the self-employment tax. So this is our first option. It's the simplest structure. It's basically just you or an LLC that you own completely, and it's not separate from you for tax purposes. It just goes on your personal return. The next structure that comes up quite a bit, and actually I think is one of the more common structures, is a partnership. So a partnership would really be used when you're going into business with someone else. Maybe that's one other person that's your partner in the business and you guys own it 50-50. Maybe there's 10 of you and you're all going into business together and you're all going to be owners in the business. In a lot of cases, those types of deals will default to being partnerships for federal tax purposes. Now, actually, several different types of entities will end up being a partnership for federal income tax purposes. The three at the top are the most common ones that we see, but it's not an exhaustive list. A general partnership being a partnership in which everybody has total liability for all of the debts of the partnership, so there's no liability protection at all. A limited partnership is a partnership where most of the partners do not have liability for the partnership's liabilities, like its debts, but at least one person does. And then an LLC is a limited liability company. You guys are probably familiar with this structure, but any LLC that has more than one owner is treated as a partnership by default under the federal tax rules. So much like the sole proprietorship that we talked about, the partnership itself actually doesn't pay federal income tax. The partners are taxed on their personal return on the partnership's income. And the income is taxable when it is earned by the partnership. And I always like to point that out because there's a difference between when the income is earned by the partnership and when distributions of profit are made to the owners. So if the partnership earns $100,000 this year but it doesn't distribute any cash to the owners, then those owners still have $100,000 in taxable income, because the timing of when the cash is distributed does not impact the timing of when the taxable income is recognized. Likewise, partners also deduct the losses incurred by the partnership in much the same way. So this is what we call a flow-through entity, in that whatever the income or losses are at the partnership level, that flows down to the owner, and it's taxed to the owner personally. A little more about partnerships here. One of the greatest benefits of a partnership is that it allows you the greatest flexibility in the ownership of the entity, meaning that most different types of taxpayers can be owners of a partnership, which is not true of S corporations, which we'll talk about later. So not only do they allow you great flexibility in who can be an owner, but also in how you allocate things between the owners. I'll contrast this more when we get to the S-Corp, but in a partnership, you can choose different ways of allocating the items of partnership income or deduction or distributions depending on the circumstances, and it doesn't have to necessarily be driven by the percentage in which the owners have owned the entity, right? So if you and I own it 50-50, there can be situations in which we decide to allocate things, maybe 30-70 instead of 50-50. It just depends on the circumstances. This partnership basis and debt basis is a big topic of conversation and a very deep area of tax law. So we don't really have time to get all the way into that today. But the main point that I want to make is that in a lot of circumstances, the debts that the partnership takes on basically give you basis or make it possible for you to take tax deductible losses from the partnership that are in excess of the amount of cash that you're investing into the partnership. I'm pointing this out because, again, I'm differentiating from the S corporation, which is coming later. This is one good benefit of a partnership. Most of the time, if the partnership is in business, if it's conducting an operating business of some sort, so if it's a professional services firm like a law firm or an accounting firm, or if it's, if it owns 10 restaurants in the Houston area, or if it does anything that's like an ordinary business and the owners are actively working in that business, or if they have basically management rights of the entity, most of the time the income from the partnership is going to also be self-employment income, which means you're going to pay both regular income tax and then self-employment tax on that income. Owners of a partnership are not permitted to take a salary from the entity. They instead get what's called guaranteed payments, which are basically like a salary for a partner, but instead of running it through payroll and having a W-2, the partnership just writes a check to you and then reports it as a guaranteed payment on your year-end tax reporting form, which is called Schedule K-1. This is important because if the IRS determines that partners were paid salaries improperly, there could be some liability from a payroll tax perspective arising from that situation. So it's not advisable. All right, so that's sort of the basic rundown on partnerships. They're very useful. We'll kind of circle back later on what's the best choice for you, but we're going to move on now to our next choice, which is a C corporation, as distinguished from an S corporation. A C corporation is a typical corporation like you guys probably think of when you're thinking about maybe buying and selling stocks, like Apple or GE or whatever it is. You can set up a C corporation for any size business. It doesn't have to be a big publicly traded company. It can be any kind of business you like. Any type of shareholder is permitted, essentially, to be an owner of a C corporation. So again, very flexible in who can be an owner, but it does not have the same flexibility of the partnership to make distributions that are not in accordance with ownership percentages. So if you think about it, when Apple declares a dividend that they're going to pay out to the shareholders, they do that based on how many shares each person has, and they can't really deviate from that. A C corporation pays its own tax rather than the taxable income flowing through to the owner. The current tax rate for C Corps is 21%, which is very low by recent standards. It's been 21% since I think 2018. But before that, it was a graduated tax rate system that went all the way up to 35%. So corporate taxes are pretty low right now. But the problem is we have double taxation, because when the corporation pays the tax and then it has money left over after paying the tax, the owners want a piece of that. And so the corporation will pay a dividend to the owners, which is taxable a second time as dividend income. And assuming it's a qualified dividend, which means that you've held that stock for basically more than a year, the tax rate on that can be up to 23.8%. So you, the shareholder, are going to pay tax up to 23.8% after the corporation already paid tax of 21%. And that's what we call double taxation. And for a lot of reasons, double taxation is something that we want to avoid. We're going to get more into that later. If owners of a C corporation are actively working in the business, they should receive a salary from the C corporation. And often you would want to, because actually paying the owners a salary from the C corporation is a great way to avoid double taxation, because the owner picks that salary up as income, but the C corporation gets to deduct it. And so it reduces the amount of tax that the C corporation is paying. And so you somewhat avoid the double taxation problem. One other reason you might want to think about using a C corporation is something called the qualified small business stock rules. We can discuss these more in another time, but essentially, if you think you might be grooming your business, if it's a startup company and you think you're going to groom it and sell it at some point, either to private equity or to whomever, you want to weigh the cost benefit of having the double taxation, which is a negative thing, to having the benefit of it being qualified small business stock, or QSBS. Because anytime you sell qualified small business stock, if you meet all the limitations and requirements, you can exclude up to $10 million of gain on the sale of those QSBS shares. So that can be a big deal. Something to think about. Here's our first bonus topic. If I can get the presentation to go forward. There we go. Is a medical reimbursement plan, which is a special type of medical plan that you can only have in a C corporation, that basically allows employees, including the owners, to submit medical expenses for reimbursement from the company. And the company gets a tax deduction for reimbursing those medical expenses, and the employees have no taxable income for receiving the reimbursement. And there's no limit. So you can do that up to any amount that's justified and provable with qualified medical expenses, which is just the normal definition that we always use for deductible medical expenses under the Internal Revenue Code. The medical expenses basically end up being tax deductible without you having to concern yourself with limitations on itemized deductions, which you normally run into when you're trying to deduct medical expenses personally, which is why most people never actually manage to deduct their medical expenses. So if you already have a C corporation and you're stuck in that structure for some other reason, this is a great thing to consider. Bonus number 2, right behind this one, is really special, and I probably would only bring this up on a Quest Trust Company presentation and not in a general presentation to other audiences, because you can use a C corporation to block unrelated business taxable income from going from a business to either an IRA or a different type of retirement plan. I don't think we've got time to get all the way into unrelated business taxable income today, but essentially anytime an IRA or an other retirement plan, like a 401k, for example, has ordinary business income, like a working interest in oil and gas, flipping real estate, basically any kind of business that's an operating business, not like a rental, but like a business, that retirement plan has to pay unrelated business income tax on that income. And that unrelated business income tax rate is essentially 37%. So there's a graduated rate system. It steps up from 10% to 37%, but you're at 37% by the time you have like $14,000 of taxable income. So effectively, as an example, I have a client who had an IRA that owned a working interest in oil and gas. And so they were paying tax at 37% on all of the profit earned by the oil and gas business. And I told them, hey, here's what we can do. Let's insert a C corporation in the middle between the IRA and the business. So the IRA owns the C corporation, which owns the business. Because the C corporation tax rate is only 21%, we're only going to pay tax on the net profits of the business at 21% instead of 37%. And there's no double taxation because dividends paid from a C-Corp to an IRA are not UBTI. And so we've created a situation where we get to pay tax at 21% instead of 37%. If you're considering having an ordinary business inside of your IRA or your solo 401k at Quest or elsewhere, I would say definitely consider this strategy. All right. The next type of entity that we'll talk about is an S corporation. As many of you might know, you may have heard of an S corporation before, but essentially an S corporation is just a corporation or an LLC that has submitted a form to the IRS to say, I want this tax status. I want to be an S corporation. There's no state level entity called S corporation. It's either an LLC or a corporation that elects this status for federal tax purposes. They're very limited in who can own them. So S corporations potentially come with some tax advantages depending on your situation, but the drawback is that you have a lot less flexibility than a partnership. So the only kind of owners you can have are are all U.S. individuals, so that's a U.S. citizen or permanent resident, or certain U.S. estates and trusts, which that certain there is perhaps another very deep topic, so we'll leave it for today. But just keep in mind for now that generally speaking, an S corporation is going to be owned by U.S. individuals or, in some circumstances, trusts. The S-Corp is also a pass-through entity. So like a partnership, it doesn't pay any federal income tax. The income and loss pass through to the owner, reported on the owner's tax return. The owners working in the business must receive a reasonable salary. Yeah, and reasonable, again, is another one of those great words and quotes here in my invisible air quotes, that there's a lot of case law about what that means, and it's kind of critical. That's a deeper discussion for another day. But just keep in mind for now that if you're an S-Corp owner and you're working in the business, you need to have a salary that reflects your efforts. Where we get a big bonus from S corporations is that the pass-through income from the S-Corp is not self-employment income. So the S-Corp shareholder will end up paying Social Security and Medicare tax on the portion that is their salary, but they avoid self-employment, Social Security, Medicare tax for the remaining portion of their share of the S corporation's income. So I have an example here that I'd like to talk about. This is an example of when the type of entity that you choose can make a big difference in your final tax result on a year-to-year basis. And this example is intentionally very simplified, but we'll talk through it. So how do I avoid double taxation in a C corporation? Well, one of the ways you avoid double taxation is to make an S election and be an S corporation instead. So the basic facts in our numerical example here are that ABC Inc. is a manufacturing company. It could be any kind of business, but I just picked that. And it earns a profit of $300,000 net profit during 2023. The sole shareholder is considered to be in the top tax bracket, which is 37%. And we also assume that all of the income is distributed to the shareholder each year because the shareholder wants the earnings of the business to use for other purposes, for their lifestyle or for other reasons. If you're a C-Corp in this scenario, the total tax liability ends up being close to $120,000 for federal income tax. Whereas if you were an S-Corp, it's only about $89,000, as you can see there. We'll walk through the math. So in the C-Corp scenario, we have net taxable income of $300,000. The company pays corporate income tax at 21%, like we discussed. So that's $63,000, leaving $237,000 of cash that gets distributed to the shareholder. The shareholder has a dividend taxable income for that $237,000 and pays 23.8% tax, like we discussed, which is composed of 20% in qualified dividend income tax and 3.8% net investment income tax, which is a whole other thing we can get into some other time. But the shareholder's total tax rate is 23.8%. They pay $56,406 in tax. So the total tax is those two numbers added together, which is $119,406. If you were an S-Corp instead, you have the same net income of $300,000. The company pays no income tax at all, and the full $300,000 of income passes through to the shareholder. The tax result is the same whether or not the cash is actually distributed to the owner or not, but I thought I'd mention that. The shareholder has $300,000 of taxable income and gets a special extra deduction called a qualified business income deduction, or QBID. So this is the 20% pass-through income business deduction that you guys probably have been hearing about over the past 4 to 5 years. This was introduced by the Tax Cuts and Jobs Act and was effective starting in 2018. So because they met all the various tests and requirements to take this deduction, which we won't get into today, they receive a deduction equal to 20% of the income from the business, meaning that they're only paying tax on $240,000, which is awesome. So even if that's at their top tax rate of 37%, their tax liability is $88,800. And so the net result, you can be a C-Corp and pay 119 grand, or you can be an S-Corp and pay 88 grand. And just here, the decision to be a S-Corp instead of a C-Corp is saving this hypothetical taxpayer $30,000 a year in federal income tax. This is not an uncommon example. And in fact, I have a lot of clients where we had this discussion early on, and then as their business grew, the tax savings were even quite a much larger number than that. So imagine what this would look like if your business had a net profit of $2 million a year instead of $300,000. It's a pretty massive difference in the end tax liability. So that is one thing to consider in your choice of entity structure. But I have another example for you as well, which is, how do I reduce self-employment tax? Now, I'm going to again show how you can use an S corporation to do this. I'm not trying to say that S corporations are the best in every situation, but for a lot of small business owners, they can be a great choice for reducing tax liability. So in this scenario, we're going to compare the difference between being a sole proprietorship and being an S-Corp with respect to self-employment tax, Social Security, and Medicare tax. So Good Times LLC, home construction company, 2022 earns a net profit of $150,000. It's wholly owned by one individual, but there are other people working in the business. So they've got, a bookkeeper, or maybe a project manager, other people working in the business. The owner has no wages or self-employment income outside of this Good Times LLC. I'm using this assumption because I needed to simplify the example, or the math would have been many slides long, and that would have been boring for everybody. So I didn't do that to you. So in this example, what you're going to find is the result here. So sorry to spoil it, but the sole proprietorship scenario ends up having a lot more tax than the S-Corp scenario from a self-employment tax perspective. So let's walk through it. So if I was a sole proprietorship or a single member LLC, as we talked about earlier in the presentation, I, as the owner, would report $150,000 of net taxable profit on Schedule C on my personal return. For reasons that are a bit in depth, the net self-employment income that's actually subject to self-employment tax is 92.35% of that number. So the amount that I'm actually going to pay self-employment tax on is $138,525. Since the self-employment tax rate is 15.3%, my self-employment tax is $21,194. The results are going to vary at higher income levels, which is why I chose $150,000 to keep it simple. But once you get above the Social Security cap, basically the difference in these scenarios isn't going to be quite as dramatic, but it's still a good tax savings tool. I also would like to point out that this net self-employment tax here of $21,194 is only the self-employment tax portion, and it's not considering that the taxpayer also has regular federal income tax to pay, because they would pay that in both scenarios. So we're just looking at the self-employment tax, which is the piece that's different. So that's the sole proprietorship scenario. In the S-Corp scenario, let's say that we determine that a reasonable salary is $50,000. The owner would receive $50,000 of wages on their W-2. And then because the S-Corp had $150,000 of profit, I would then subtract the $50,000 salary. And then, so the owner would only get $100,000 of net pass-through income. That $100,000, though, is not subject to self-employment tax. So the only Social Security Medicare tax that the owner is going to pay is on the salary, which ends up being $7,650 between the employee's share and the employer's share. So that's how you save $13,544 per year in a company that makes 150 grand. You make the S election and you pay a reasonable salary to the owner, and you take the rest of the S-Corp profits as just distribution of profit. So you end up, instead of having $21,194 of self-employment tax, you end up with only $7,650 of Social Security and Medicare tax. So it's a powerful tool in the right situation. So that brings us to the big question. Which is best for my business? Which federal tax classification? It depends. In tax, we always love it depends. That's our favorite answer, because it does. It really depends on your personal circumstances and the circumstances around your business in terms of how much money does it earn? How many owners are there? What type of owners do you have? How are you allocating things between the owners? And a whole host of other factors. So when trying to decide which structure is best for your business, you have some basic info now and some thoughts on what might work better than others in certain situations, but always consult with a qualified tax professional to determine that. Okay, so we've been talking up S corporations for the past several slides, so now we're going to talk them down. So when is an S corporation a bad idea? Well, one time that an S corporation is a bad idea is if you're trying to hold rental real estate. There's a few reasons for that. The first reason is debt basis limitations. So earlier in this presentation, when we were talking about partnerships, you may have heard me mention that in a partnership, you can deduct losses that are in excess of the amount of the investment that you made in the partnership, if the partnership has debts. So in other words, if there are losses funded by debt, you can deduct those losses for tax purposes, subject to other limitations, of course. In an S corporation, you generally do not have that ability to deduct losses that are in excess of your investment amount. In other words, it's a lot harder to have debt basis in an S corporation compared to a partnership. The only debt of an S corporation that counts for your basis is money that you loan to the company as the shareholder. So if the S-Corp borrows money from a bank, you don't get basis for that. So you cannot take losses in excess of your investment amount if all the S-Corp has is bank debt. Well, what tends to generate a lot of deductible tax losses and also tends to have bank debt? Well, rental real estate is a great example of that. So a lot of times when we have rental real estate, like for example, a multifamily apartment building, we can do a cost segregation study to get a lot of depreciation expense on the front side. And so we front load a lot of the tax losses. Well, those losses aren't really going to help you if that property is held in an S-Corp. They'll help you somewhat. You can take losses up to the amount of money you invested, but beyond that, you cannot deduct additional losses because you don't have debt basis like we just talked about. So that's the main reason. But another reason that S corporations aren't great for holding rental real estate is anytime you distribute appreciated property out of an S-Corp, it's a taxable event. So essentially, when you distribute appreciated property out of an S-Corp, it's treated as though it was sold for its fair market value on the day that you distributed it. Does this happen a lot with real estate? Not really. But sometimes people will regret later that they put their property in an S-Corp and they want to own it personally for some other reason. And they're stuck because if they take it out of the S-Corp, they're going to have to pay tax even though there wasn't really a transaction. By the way, this also comes up a lot when people have marketable securities like stocks or bonds in their S-Corp. Also generally not a great idea for the same reason. One final reason is that there's no step up in the basis of the real estate of death. This is more of a complex, maybe a 202 kind of topic rather than a 101 kind of topic. But, generally speaking, when someone passes away, their heirs get a step up in the basis of that property. And if that property is S-Corp stock, that's great. They have a higher basis in that S-Corp stock if they ever sell it. But they don't get to take advantage of that stepped up basis for depreciation purposes like they would if that property had been instead owned in some other type of structure. So that's why we don't generally recommend S-Corps for real estate holdings. See that we're at the 12:43 mark here, my time. So we're gonna try to take a good pace through the remaining topics here so I can make sure we get to everything. We'll talk about the difference between cash basis taxpayers versus accrual basis taxpayers. But essentially, this is a discussion on getting the timing right on your income and your deductions. And a lot of times you can choose whether you're cash basis or accrual basis. The only people who really can't choose cash basis are C corporations that have revenue over $29 million on average over the past 3 years, and that $29 million is indexed for inflation. But let's just say C corporations that have a pretty good sized business are probably not eligible to be cash basis taxpayers. And then the somewhat vague term tax shelters. So a tax shelter is not eligible to be cash basis. And what's a tax shelter? It depends. That's our favorite answer. But generally speaking, if you have an entity that is invested in, again, rental real estate, and most of the owners are passive in the business, they're not working in the business, then that might be considered a tax shelter. This is why a lot of rental real estate entities, like all these apartment syndications we like to invest in, are accrual basis because they have to be. So what is accrual basis? What is cash basis? Well, a cash basis taxpayer recognizes taxable income when they collect cash from their customers. So if I'm a CPA, which I am, if I send an invoice to my customer, as a cash basis taxpayer, I don't have income when I send them the invoice. I have taxable income when they pay me in cash, when they pay me the money. And I take tax deductions when expenses are paid. And paid here does include payments via credit card. So payments made via cash or credit card, those are deductible when they're paid. An accrual basis taxpayer actually works to set up its books so that it's recognizing income when the income is earned, regardless of when it's paid. And it always wants to deduct expenses in the period that those expenses are associated with, rather than when those expenses are paid. So that's maybe a little more in depth. We'll get to it in a moment. We're going to talk about cash basis first. So when is cash basis the better choice? Anytime you have your accounts receivable at the end of the year typically being higher than your accounts payable. If you want flexibility in timing your revenue and expenses, or if you want to have very simplified accounting, being an accrual basis taxpayer means that you have to maintain accrual basis financial records, which if your accountant for your business is your child or your spouse or your mom or your brother, may be a little tough if they don't have an accounting background, right? So in a lot of times in small businesses, they prefer cash basis because it's easier to keep track of. As far as wanting flexibility in timing revenue and expenses, the way that you would actually accomplish that is if you want more deductions in 2023, for example, you would prepay a lot of your expenses that you're going to owe in early 2024 in December so that you get those deductions now. Or as another example, you could hold off on sending out your invoices or tell your clients to hold off on paying you until the first week of January instead of the last week of December, and then you've effectively shifted that taxable income forward a year. When is accrual basis better? Well, kind of the opposite situation, usually when payables at the end of the year. So you owe more money than people owe you. When your payables at the end of the year are higher than your receivables, because you get to deduct those payables now and you pick up that income now. But if your payables are higher, then your total taxable income for the year would be less than it would be under cash basis. Another good example would be when the taxpayer wants a more accurate picture of their profitability, and they also want their tax returns to reflect that, maybe for banking purposes. A lot of times banks want to see that you have healthy income and that you have smooth net income over the long term, which is the third point. So accrual basis tends to be smoother, but gives you maybe a little bit less flexibility in choosing the timing of your taxable income. So we'll move on to our next topic. which I'm going to try to probably get through pretty quickly because there's a lot of detail here that I'm not sure that we really need to get to the main point. So I will try to be prompt with it. But should I lease or should I buy my business vehicle? That's one of the most common questions I get in my business. People call me all the time. Hey, I want a new car and it's going to be business use. Should I buy it or should I lease it? Well, I always say, the first thing I say to them, it never makes sense to spend $1 to save 30 cents on taxes. So I think your primary consideration should always be what makes the most financial sense. And that depends on things like interest rates and lease terms and how much you're going to drive the vehicle and how long are you going to keep the vehicle and a bunch of other stuff that I don't usually have that information when I'm talking with them. So usually they want my advice on the tax considerations, which in my opinion are the second priority here. It's important to keep in mind that generally speaking, only the business use of a vehicle is tax deductible, which means that you need to track your mileage as required under the IRS rules. And keep in mind that driving back and forth between your house and your office is not business use specifically under the rules. The tax implications of leasing a car are that the business gets tax deductions for the business use percentage of all the expenses it pays for the vehicle. So that's the lease payments, insurance, gas, repairs, maintenance, whatever else. So you can either deduct the business use percentage of those expenses and then not deduct the remainder. Or an alternative way to do the accounting is to have the business deduct 100% of those expenses, and then the driver of the vehicle has to pick up taxable income for the value of the personal use component. There's no depreciation in a lease vehicle because the business does not own the vehicle. You have to own something to depreciate it. The tax implications of a purchase auto are similar but different. The business gets tax deductions for the business use percentage of the interest on the loan, if there's a loan, insurance, gas, repairs and maintenance. It also gets to take depreciation expense. Depreciation on a van, truck, or SUV over 6,000 pounds is not limited. Any other kind of vehicle that's a passenger automobile is subject to the luxury auto depreciation limits. Please note that bonus depreciation and Section 179 expense are not applicable if the business use of the vehicle is less than 50%. So what are the luxury auto depreciation limits that apply to most business vehicles unless they're a van, truck, or SUV over 6,000 pounds? Well, here they are. This is the maximum amount you can depreciate each year. Obviously, these are pretty high, right? So, if you have first year depreciation of $20,200, then your vehicle probably costs, several tens of thousands of dollars to be able to depreciate it that much. So this really applies, where I see this come up the most as a limitation is vehicles that are very expensive, maybe say above $50,000, $100,000, $150,000 vehicles in that range. So that this is relevant for that. As we said, a van, truck, or SUV over 6,000 pounds has no annual limits on depreciation. So through 2022, you had 100% bonus depreciation in the tax code, which means basically you could expense 100% of the business use cost basis of the vehicle in the year of acquisition. So if you bought an $80,000 SUV and it was 100% business use in 2022, you could take $80,000 of depreciation in the first year. Pretty cool. Bonus depreciation is stepping down over time. So this gets less powerful as the next few years go by, unless the tax law changes. But still, if you're buying a van, truck, or SUV over 6,000 pounds before the end of this year, you can take bonus depreciation on up to 80% of the business use percentage of the cost of that asset. I'm going to skip over Section 179 because I feel like it's not very compelling at the moment. So lease or buy, which one is better? Again, consider the financial ramifications first. From a tax perspective, if it's a van, truck, or SUV over 6,000 pounds, you may, in most situations, come out ahead in the short term by purchasing the vehicle due to bonus depreciation rules right now. Other vehicles, it really depends on the situation. It is important to note that if you ever sell or trade in a vehicle that you took depreciation on, the depreciation recapture rules do apply. So if I in my previous example, if I bought that $80,000 SUV and I took $80,000 of depreciation, and then 3 years later I traded that vehicle in for a different car, I would have taxable income up to the amount that I traded it in for because I fully depreciated the vehicle. So there's no free lunch in tax, just like there's no free lunch anywhere else. It's an in and out kind of system, but you get a tax deduction today, and then at some future time when you sell the vehicle, you might have taxable income. So something to keep in mind. Our last topic for today is retirement plans. We're going to talk about putting away tax deferred dollars for retirement, which is a great thing for every business owner to be thinking of. There are a lot of different kinds of retirement plans. Here they are listed for your viewing pleasure. When should you use these? Well, really, it depends. I do want to point out HSA, I put secret retirement plan, because a lot of people don't think about HSAs as retirement plans. They think of them as an account that they can use to pay their healthcare expenses with a tax deduction for putting the money in the account in the first place, which they're great tools for that. But here's a fun fact. You can actually reimburse yourself for your qualified medical expenses that you pay personally from your HSA. And you can do that at any time. You can do it 40 years later. So you have this pool of money that you can draw from when you need it. If you track all of your receipts and you keep track of your medical expenses over the years, you can reimburse yourself from that plan later. And also, I think it's at age 65, that HSA pretty much kind of turns into an IRA as well, where you can take the money out and pay tax on it, but it grew tax deferred for that whole period of time. Something to think about. Here's some pros and cons to consider for tax deferred retirement plans. You know, obviously the main big good thing is you get an upfront tax deduction unless it's a Roth contribution. Your assets tend to compound in growth faster because that growth is tax deferred, unless you have unrelated business taxable income, of course. And there's a large variety of investment options you can choose, especially with a self-directed account. You know, talk to Quest about that. They have the info. Cons would be withdrawals in retirement are ordinary taxable income, except for if it's a Roth account. There are penalties that apply in most cases if the funds are withdrawn before age 59 and a half. And then you have required withdrawals starting at age 73 or age 75 if you're born 1960 or later, which can force you to have taxable income maybe when you don't want it. It just depends. Some people see that as a disadvantage, depending on their situation. Traditional versus Roth is a question that always gets asked. Should I make traditional contributions to my 401k or IRA or Roth contributions? Well, in a traditional tax-deferred retirement account, you get a tax deduction when the contribution is made. The earnings grow tax-free, and then you pay taxes on all the money you take out when you retire. In a Roth IRA or 401k, you don't get a tax deduction when the contribution is made, so you're paying tax today. Your earnings grow tax-free, but the bonus is that you get, when you take the money out in retirement, you pay no taxes at all, which is better. As always, it depends. Traditional IRA or 401k usually works better when your tax rate is higher now than it will be in retirement. Whereas a Roth account usually works better when your tax rate will be higher in your retirement than it is now. Something to think about with respect to tax rates. Right, so we want to be able to predict whether my tax rate's higher now or in retirement. Is my taxable income likely to be higher or lower when I retire? Will the statutory tax rates be higher or lower when I retire? Right. So first of all, what tax rate you're paying depends on your income. Will your income be higher than it is now or lower? And will the government change the tax rates? Will the tax rates be higher or lower when I retire? I'll give you a hint. Current tax rates right now are relatively low by historical standards. So it seems more likely to me personally that they'll go up rather than going down, but I don't predict the future, so who knows. We are pretty much at time, but I'll try to get through this in 2 minutes. I've got 2 more bonuses for you that I think you would like. Has anyone, well, you can't answer me, but I wonder if anyone in the audience has heard of a backdoor Roth IRA. I assume a lot of you have. A backdoor Roth IRA is a tool that you can use when your income is too high to contribute to a Roth IRA. So the Roth IRA has income limits above which you cannot contribute. So you can get around that by making a non-deductible traditional IRA contribution and then immediately converting it to a Roth IRA before it earns any income. And so the effect of that is that that conversion is non-taxable. And so effectively you contribute to a Roth IRA even though your income is over the threshold. If you do still have funds in a traditional IRA when you do this, that conversion would end up being partly taxable. So you can think about getting around it by rolling over your traditional IRA into your employer's 401k so that you no longer have funds in a traditional IRA when you do this. And then our last bonus is the mega backdoor Roth IRA, which is a similar strategy but utilizes a Roth 401k instead of an IRA. And so you can use this to get up to $43,500 into a Roth 401k in 2023, which is crazy good. But unfortunately, most employer plans make it really difficult to do this. If you're setting up a solo 401k, you want to look at these rules and make sure that you're able to set up your plan to allow this if you're interested in using this strategy. So not all workplace plans allow you to make an after-tax contribution to your 401k, basically a non-deductible contribution. That is a requirement for the strategy to work, and I would say the majority of plans don't allow it right now. So something to consider, something to ask your HR about if you're still employed, or to look at if you have a solo 401k. But much like the other strategy, you then immediately roll that after-tax contribution to a Roth account inside the 401k, or roll it out to a Roth IRA. If your 401k plan allows in-service rollovers out of the plan, which most don't, but some do. All right, guys, that's it for the content. I'm here to take your questions if you have any, or if there aren't any questions, we can wrap up. But happy to take questions. I think a question just popped up on the screen here. I don't know if that's the first question we've had or not, but someone asked, what's the difference between a Roth IRA and a Roth 401k IRA? Well, there's no such thing as a Roth 401k IRA. A Roth IRA is an IRA that it's Roth. So you don't get a tax deduction for putting the money in. You don't pay tax when you take the money out. A 401k can have something in it that's called a designated Roth account. And essentially, it's a Roth account that's inside of the 401k. So what's the difference is that one of them is an IRA and the other one's a 401k. So a 401k is a qualified retirement plan usually associated with an employer, and an IRA is an individual retirement account that people set up for themselves. So that's the main difference there. Quest team, I'm not sure if there have been any other questions or where I would see those. Oh. Okay. All right. Let's see here. Looking for questions. About 25 minutes ago, Steve mentioned that on the S-Corp, the owner would have been taxed on his salary as well. I think he's probably referring to the self-employment tax example, which you're correct. You would end up paying federal income tax on both the salary and the S-Corp pass-through income. The example was focused on self-employment tax because that's really the difference between that example and the sole proprietorship example. Yeah. Were there any other questions? So I'll wait maybe one more minute here, and then if not, I'll do my little wrap up at the end. I do hope that you guys enjoyed the presentation and had a good time learning about taxes, which is one of my favorite topics. Let's see here, we'll go to the next slide. If you need to contact me, the best way to do so is via email. There is my email address there. Or you can go to our website, mgallp.com, and there's a little contact us box. I think it's in the top right. We're always happy to help talk to you if you're a business owner that has an operating business. Again, we mostly operate in that $5 to $100 million range. If you're a little below that, well, we're still happy to take a look and see if it could be a good fit for working together. If you have UBTI questions, happy to help with those. Feel free to reach out if I can help you guys with anything, or if you have any questions about today's presentation.
And I don't think I see any other questions coming up. So threw a few of them on the screen, as well as some thanks from the audience just for coming out and sharing your information. So we certainly appreciate it. And for everyone either tuning in here at the last minute, or if you didn't catch the full presentation, we will be archiving this as well on our YouTube page. So you will be able to revisit this presentation from Adam. And we thank you so much for coming out with us this afternoon.
Yeah, thank you guys for having me. It was great to get to talk to everybody about taxes, and I look forward to seeing you guys again sometime.
All right, everyone. Well, thanks for joining us, and we hope that you enjoyed the rest of your Saturday. We'll see you next week, same time, same place.